Today, we're diving into something big that affects both the buyers and the sellers in our market. The Bank of Canada just dropped its key interest rate, and yes, this matters for you, whether you're thinking of buying, selling, refinancing, or just watching from the sideline to see what's happening. In this video, we are going to break down what happened, how it affects you, and what it could mean going forward, especially for real estate transactions in the Ottawa area right now. Let's get right into it. Here is a quick recap. The Bank of Canada cut its overnight target rate by 25 basis points. More specifically, the Bank of Canada reduced the rate to 2.25%. So what's important? This was the second consecutive cut. Prior to this, they had cut it down to 2.5%. Why did they do it? A few big things. Number one is the economy in Canada is showing signs of softness, weak export, trade pressures. Number two is inflation is coming down, staying closer to their 2% inflation target. Number three is they want to support growth without letting inflation run away. So essentially, borrowing costs may go down, spending could pick up, and the Bank of Canada is signaling caution, but also that we might be near the end of the cutting cycle unless things deteriorate further. So now we know what happened. Let's talk about why it matters to you. For home buyers, if you're hunting for a home right now, here is what the rate drop could mean. Number one is variable rate mortgages. These often move more quickly when the Bank of Canada changes the policy rate. What that means is your monthly payment could drop a little bit, depending on your lender and margin. So if you're locked into a variable mortgage or have one in your near future, this is good news. Number two is the fixed rate mortgages. These won't change immediately just because of a Bank of Canada cut. They're tied more to longer term bond yields. So you might not see big movement overnight in 5-year fixed rates, but the environment is more favorable. Lower rates reduce risk of them rising further. Number three is more affordability. Lower borrowing costs means that you might qualify for a little bit more or have a little bit more flexibility. That opens up opportunities, especially for first-time home buyers or those trading up. But you still have to be very cautious. Even though the Bank of Canada cut the policy rate, the real cost of borrowing depends on what your lender charges, your credit, your down payment, and everything else that goes along with it. It doesn't auto-guarantee a big, huge rate drop. And as a realtor, I would say for buyers, this may be a small green light to move, but still do your homework. Your down payment, your debt ratios, your stress test, your neighborhood fit. All of these things are still very important. And for sellers, this is also very interesting. Lower rates can mean more buyers in the market since affordability improves. That could help generate demand, which is a positive thing. On the flip side, if buyers believe that rates will go even lower, they might try to wait. So there could be some what if, and maybe I'll wait, I'll see what's going to happen. That hesitation could still be out there. If you're moving up, selling your current home and buying the next one, your monthly payment on the next place may be slightly lower. That's a psychological plus you can actually lean into. For those who are refinancing, if you're planning to renew or tap into your equity, the rate drop gives you some leverage. Talk to your mortgage broker to see if you can refinance at a better rate. If you have a variable or adjustable borrowing like a HELOC, line of credit, a second mortgage, cheaper rates means potentially less interest expenses. If you were thinking of doing a renovation or a home equity play or an investment property, cheaper money will help. On the caution side, lower rates can stimulate demand, which in a tight inventory market could push prices up. Meaning if you plan to buy later, you might face higher prices. And here is what I'm thinking about this for our market. The inventory is still a challenge in many desirable neighborhoods. Combine that with a bit of rate relief could spark more showings and more offers. Buyers who were hesitating because rates felt too high might get off the fence, so keep an eye on those spring-like momentum earlier than usual. For sellers, if you were thinking of waiting until the rates come down more, you might be tempted right now. But remember, timing the market is very tricky, almost impossible. With rates down, you might get more competition, so it could be a good time. And when I'm talking to mortgage brokers, they are saying yes, this helps, but the major driver for home affordability remains the purchase price plus the down payment plus regional supply and demand. So it's not just about the rate, and always mention that to my clients. You can't just be buying a house now because the rates are lower. So what does this mean for the future? Let's talk about what this drop could mean going forward so you, the buyers, and the sellers can plan ahead. The rate cut cycle and basically what's next. As we noted, the Bank of Canada signaled this might be near the end of the cuts unless things get worse. Economists are mixed. Some say fewer cuts, some say we may hold here for a little while. If inflation picks back up or the labor market strengthens, we could see rate increases down the road. So this drop isn't a guarantee of fewer low rates. If you are locking in a fixed rate for 2025, 2026, this environment could mean slightly better rates than just a few months ago, or at least the pressure is off the upward drift. If you are short-term, like in a variable, there's more room for downward movement, but also more risk if the Bank in Canada reverses course. So when I advise my client is, can you handle the ups and downs of your mortgage payments changing? If you lock now, you have flexibility. If you wait, assuming rates will fall more, you may risk higher price or missing out on a property. Because remember, property prices could be moving when rates move. So what about these property values and the market behavior? Lower rate equals more buying power. This could push prices up, especially in constrained supply markets, which is many segments of the Ottawa area. But if the economy remains weak or jobs data remains weak, then buying demand might still stay muted. So it's not an automatic thing. If home buyers rush in because rate relief, but inventory doesn't keep up, we could see bidding wars again. Good for sellers with well-priced homes. On the other hand, if more homes come on the market because sellers decide now is a good time to sell, then inventory might go up a little bit more, giving buyers more choice. Keep an eye on new listings and days on market because this will have an impact. Let's talk about strategy. For buyers, use this rate drop as one of the levers. Review your options, fixed or variable. Consider how long you plan to stay in the home. Factor in that rate that could move up or down. For sellers, if you're thinking of listing your home in the next 6 to 12 months, now is a good time to prepare. Fix those cosmetic issues, align your pricing strategy, and build momentum while the buyer sentiment may improve thanks to that rate relief. So for investors, the lower cost of money is more favorable. But watch the region. You want markets where rent fundamentals, the supply, demand makes sense. For refinancers or existing homeowners, talk to your broker about whether refinancing or a HELOC makes sense in your situation. Here are 3 things I'm telling my clients right now. Number 1 is neighborhood supply is tight. Good homes, good neighborhoods are still getting some attention. So when rates go down, it can spark increased showings. Number 2 is your commitment to financing still matters. Even with lower rates, lenders still assess debt service ratios, your down payment, your property condition. So don't assume that the rate drop equals automatic approval. So number 3 is timing matters, but it does it over time. Some clients say, I'll wait for even lower rates, but waiting could mean higher competition, fewer homes, or price increases. We balance rate timing plus market timing. If you're a buyer or seller in the Ottawa area and you're unsure what to do, send me a quick message. We can map out your scenario because everybody's situation is different. And if you're watching this for education and not planning to move immediately, that's great. Use this as part of your long-term plan. Keep an eye on rate trends, keep your credit and down payment in good shape. Stay ready. All right, let's do a quick recap. The Bank of Canada cut its key rate to 2.25% the second time in a row. This matters for borrowing costs, affordability, and gives a little boost to buyers and existing homeowners. But it's not a magic fix. Market supply, local conditions, your personal finances still rule and they still matter. Looking ahead, this could be a good window of opportunity, but also a moment to be careful and strategic. Thanks for taking the time to watch this video. If you found it helpful, feel free to share it, hit the thumbs up, and don't forget to drop a comment below on what you think about these new rate drops. Also, don't forget to subscribe to my channel for more straight talk on real estate. I will see you in the next video, but in the meantime, if you have any questions about real estate, make sure to give me a quick call, or you can always email me at jeanricher@jeanricher.com. Merci beaucoup et bonne journée.